I think this flows nicely into areas you're finding opportunities. Let's get into some of your high conviction sector picks.
Yeah.
ProPicks is brought to you by ATB Financial. With $62 billion in assets, ATB Financial is powering possibilities for more than 820,000 financial services clients in Alberta and beyond. ATB's capital markets arm is a full-service investment dealer that offers investment and corporate banking, sales and trading, institutional research, and risk management. Visit atb.com/inthemoney for more information. Ed, you made headlines when here you are, this long, staunch bull in a bull market where people love to throw, pessimism at it.
Yep.
And then you come out and you say, 2026, underweight the Mag 7. Did that feel a little bit like blasphemy?
Not really. It feels kind of like watching Game of Thrones. For many years, there have been like 7 independent kingdoms surrounded by huge moats, and they all kind of left each other alone because they were all prospering in their own kind of relatively monopolized businesses. I think AI changed all that. Suddenly, they found themselves competing in the AI space and getting into each other's businesses, and as a result, there's a lot of competition. It's the AI arms race, if you want to call it that. And as a result of that competition, they are spending a tremendous amount of money on AI infrastructure without having a clue what the rate of return is going to be on that investment. Imagine that they just build all these things and finish all these data center in the next year or two, and then NVIDIA says, "Oh, by the way, we have a chip that we can actually sell much more cheaply that doesn't require anywhere near as much energy. It doesn't need to be cooled," or somebody else comes up with that. And NVIDIA has to come up with that because if they don't, their competitors will. That's what competition does. And so suddenly it'll be a lot cheaper to build these data centers. Maybe we don't have to send them out into outer space, which is kind of the latest discussion of what we need to do with data centers. So it's the competition that's changed for me. And that means, look, you're always going to get eventually competition if you have a company that's got an amazing profit margin. Competitors are going to be attracted to that. Say, well, we want some of that, and we could do it better, faster, cheaper, and that eats the profit margin of those who are ahead of had been ahead of the situation. I'm also arguing that, hey, look, the Magnificent Seven, they are magnificent companies, but they're not going to stay magnificent unless all these services, products, hardware that they produce are sold to customers, like the S&P 493. These are the companies that are actually going to benefit, going to increase productivity from the tools provided by the Magnificent Seven. So all I'm saying is I think the market's actually broadening out. It's actually more bullish. I think it's not going to be limited to or concentrated in the Magnificent Seven. I think the 493s start to do better. The mid caps, the small mid cap stocks have done better, but I just don't see that their earnings are showing the kind of upward trajectory that I'm starting to see in the S&P 493.
All of the concerns that you mentioned were concerns that were percolating last year too. And so, yes, we did see a little bit of a slowdown in some of those stocks, not Google. But I guess my question is, why do you think this shows up in 2026? Is it because we're already seeing signs of exhaustion? And even if the NVIDIA, say they can't charge as much, isn't that good for, Meta, Microsoft, Apple, Alphabet that actually have to use that, as long as the AI itself, takes off? And I'm asking because we just talked about how, bears can scare you out of the market. So, but it sounds like you don't feel like you're scaring people out of money-making opportunities by saying underweight this.
No, I'm just saying that you don't, right now the Magnificent Seven account for about 35% market cap of the S&P 500. I mean, that's very concentrated, certainly isn't diversified, and rightly so, because they have been outperforming. But I think semiconductors could do quite well without NVIDIA necessarily participating in that. I'm so basically what I've observed is that these companies, are actually getting into Nvidia's business. I mean, for me, the big event was when Google suddenly came up with Gemini 3, and that outperformed OpenAI, and OpenAI has sort of been the epicenter of the AI revolution. And now Google's saying, "Well, wait a second, we can make chips. We have these TPUs, which in some functions do a lot better." Don't forget, or you'll recall that there was a pretty significant correction in the Magnificent Seven in January of last year, and a dinky little Chinese company that came out of nowhere called DeepSeek,
Yeah.
and everybody started to say, holy smokes, maybe we don't need to spend all that money on data centers. Maybe we don't need to spend all that money on NVIDIA chips." And the Magnificent Seven came back during the first and second quarter earnings season. So, oh, no, no, we're still going to spend it. We still think we have to spend it. Sam Altman over at OpenAI says, we could cure cancer today if we had all the capacity that AI needs to do the job. So there's a lot of hype in that AI space. And I think right now, what really has changed last year is now there's a lot of uncertainty. How much is too much in terms of capital spending? What kind of return are they really going to get? Are they sure that NVIDIA isn't going to, kind of uh, blow up their investments in the current NVIDIA chips a year from now when NVIDIA comes out with better, cheaper, more energy efficient chips, or if not NVIDIA, AMD, or Gemini, or whoever, or a Chinese company. So that's the reason there's more uncertainty about the Magnificent Seven. I think there's less uncertainty that the 493 can definitely use these technologies to increase productivity. And oh, by the way, last year was an amazing year for productivity. Not so much in the first quarter, but second, third, and fourth quarters are awesome.
Do you attribute that to AI?
I do in some ways. I think a lot of you know jobs, rudimentary jobs probably don't aren't there anymore because of AI. But I would say that what AI has done is it's forced every company management, every business, every all of us individually to look at how we do things and say maybe we could do it more efficiently with AI. And so I wouldn't be surprised if a lot of companies look at it and said, not ready for prime time. But while we were looking, we found that this whole department is useless. So let's just get rid of them.
And I guess that supports your reason of like how things get better for the 493.
Correct. Yeah, the AI is sort of an eye opener. It kind of forces you to look at your entire organization and said, what part of this organization might actually benefit from that? And there will be benefits to it, and there'll be future benefits as AI gets better at what it's doing, fewer delusions, and and gets the job done.
So your recommendation is, I mean, you're right. It's a huge part of the S&P 500. So just don't make it that big. Maybe in your portfolio, a teeny, 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 tiny part of the S&P 500 is materials, and even smaller is precious metals. But that's a sector that you would overweight. And of course, we got loads of that here in Canada.
Yeah. I would. I had been promoting the idea of overweighting technology and communication services. Put them both together; they're basically technology, and they account for 45% of the S&P 500. And again, like my thinking about stay home versus go global, I suddenly realized that hey, it's worked. And now, do I really want to recommend an overweight on two sectors of the 11 sectors in the S&P 500 that account for 45% of the S&P 500? And the answer is no, I don't. And so I would market weight those two sectors. I'm not underweighting them. Within technology and communication services, I'm underweighting the Magnificent
That's
Seven.
right.
Now, what do you do if you lighten up? It's basically rebalancing. If you have a portfolio and some stocks do amazingly well, maybe it's time to take some of the profits and move it into other areas. And I've been recommending overweighting financials, and I'm still doing that. They had a little sell-off and Trump talking about credit card debt interest caps, but I think they're going to do just fine. Industrials, this thing continued to do well from onshoring. And like you said, I mean, it's so easy to overweight energy and materials because you need a magnifying glass to see their market capitalization. But I've been recommending overweighting gold. I should have been recommending overweighting precious metals because it's the whole complex that's done well. But when gold rose above 2000 in 2024, I said, I never had an opinion on gold because I'm a old-fashioned strategist. I need earnings. I need something I can value. But when it crossed above 2000 in 2024, I said, this central bank idea that central bankers are buying more gold after Russia invaded Ukraine and we froze their foreign exchange reserves, maybe that's all you really have to know. So I said, I'm bullish on gold. But I got no way to tell you where it's going. Then it rose above 3,000 at the beginning of last year. And I looked at the chart and I said, hey, I can do this technically. I draw a little channel and that'll get us to probably 4,000 by the end of last year was my prediction. Well, we got above that, about 4,500. And then I had been predicting 5,000 for the end of this year. Now I'm using 6,000 simply because it's just moving so fast. And it's no longer just about central banks. I think there's a lot of other issues. I think a lot of Chinese investors who got destroyed in the property market and get whipsawed in the stock market, like an asset that just goes up every single day, and every now and then gives you a day where it gives you a little bit of a buying opportunity. So the precious metals still look fine. Even some of the basic metals look fine. Oil is another kind of issue here. It looked like it was about to break down, and then there was a breakdown in Iran, and of course we had the Venezuela situation. I still think there's a lot of oil out there, and I'm not convinced that the downside is over for oil.
So market weight largely tech, overweight some of the more cyclical areas, financials, industrials, and those metals. I didn't hear in there, but I do know that you're overweight healthcare. And I think that's interesting because it's kind of been an orphaned, unloved sector. And why do you think 2026, it's got some great characteristics. If you like growth, there's growth. If you like dividends, it's dividends. If you like low valuation, it's low valuation. Why is this the year for healthcare?
Well, a lot of the market cap of healthcare is in pharmaceuticals, and the pharmaceuticals pipelines are drying up, and they're desperate to get new products, and so they're all looking at the biotech companies, and there's so many biotech startups and ventures out there that have cures for everything you're gonna imagine, and some of it, of course, is hype and isn't going to play out, but some of it is going to play out and can be leveraged up to have a positive impact on more people. So I think the pharma. I think we're just in the early stages of a great M&A boom in the healthcare industry, and I think that right now it's benefiting the biotechs. But then once these state-of-the-art biotechs get acquired by the big pharma and they leverage up those kind of new innovations, then the farmers do very well. So the big issue always is politics. There's a lot of controversy over Obamacare and subsidies and all that. But at the end of the day, as we said, it's PE times E, and the earnings outlook is looking quite good.